And at the outset, I'd like to submit for the record a letter submitted by SIFMA evaluating the impact of capital proposals without objection. That will be submitted for the record. So Ms. Valladares today has repeated an argument that I recall former Vice Chair Michael Barr making during the 2023 proposal. Mr. Barr, I'll have you comment on this. The argument goes something like this: higher capital requirements lead to higher credit ratings for banks, which help lower borrowing costs for banks, which in turn allows them to pass on those lower costs to American consumers in the form of more lending and lower cost of credit. This seems pretty counterintuitive, given that higher capital requirements constrain the ability of banks to deploy capital into the real economy. Can you address this argument?
Sure. It is clearly the case that to the extent a bank has more capital, its credit ratings will go up, and it should be able to borrow marginally less cheaply. So that is a benefit. On the other hand, there is a cost. And the most expensive way for a bank, or any other company for that matter, to fund itself is through equity. And that is why most companies try to diminish the amount of equity that they have to hold. Again, as someone who's worked inside a bank, the CFO, the corporate folks, they know how much equity costs. They know their cost of capital. And they monitor it, and they mete it out to the lines of business that can earn the highest return on that equity. They do not ignore the cost of equity. And of course, you know, if you read any analyst report, talk to any investor, they're all very focused on this proposal. Under that analysis, they would be completely indifferent, because the increase in cost for equity would be matched by a decrease in cost for debt. But everybody operating in the markets, all people who invest in banks, know that's not the case.
Mr. Degengi, I'll have you also address that argument. And how does the revised framework ensure that higher capital requirements do not unnecessarily constrain lending to creditworthy borrowers?
Well, I think they do so by becoming more risk sensitive in calculating the risk-adjusted amount of bank exposures. I mean, one of the things I would note is that under the new rules, risk weights do not just go down, they also go up. So there's more risk sensitivity. If capital requirements in the aggregate go down, it's probably because banks' exposures are concentrated at the lower risk end of the scale. If banks' exposures were concentrated at the higher risk end of the scale, then capital requirements would go up under the new proposals. So I do think they are more risk sensitive, and therefore allow a more risk sensitive pricing and availability of services.
But just going back to the 2023 proposal, is it fair to say that this argument that the higher capital requirements would have led to more lending, is that a debatable point?
I think it's debatable based on my experience as a lawyer advising banks. Banks pay careful attention to the risk-weighted asset impact of any asset class, and they have a hurdle rate, an internal hurdle rate. And if an exposure doesn't meet that internal hurdle rate, they will change the pricing or change the availability.
And I think a lot of the economic analysis on the 23 proposal was that, in fact, lending would go down substantially, materially. Let me go to this gold plating argument. Back to you, Mr. Barr. Mrs. Valladares makes this argument that more regulation actually enhances the reputation of American banks, and therefore American banks become more competitive with gold plating. Do you disagree with that? And why is, and do you think that the most recent proposal on Basel III finalization moves us away from gold plating?
It is true that one reason U.S. banks have done well is that they and the regulators in the immediate aftermath of the global financial crisis were quicker to rebuild capital than those in Europe and other places. So that is certainly true. But around the gold plating, I mean, the fact is the current proposal is closer to Basel norms than the 2023. The 2023 proposal just spuriously added capital requirements to Basel. So here, whether it's the risk weights around consumer, mortgage, the securities listing requirement that I believe Congressman Sherman mentioned, we are now more in line with the EU and UK adoption of that proposal. Well, the remaining big gold plating really is in the stress test, and as I think Luigi mentioned with regard to op risk, it's a double count, and certainly with regard to market risk.
Well, that corroborates what the Basel Committee actually told a bipartisan delegation that traveled to Basel, was that the 2023 proposals actually moved away from Basel III proposal because it was excessive relative to what the international standards were. My time has expired. The chair now